Welcome to the deep dive. If you've ever felt just buried under financial news trying to figure out what is really going on with a company, well, you're not alone. It's tough to cut through that noise. We're here to help with that, taking these dense reports and finding those key insights, those moments where you go, aha, now I get it. Today, we are diving deep into Intel Corporation, specifically their Q2 2025 earnings analysis. Our mission here is simple. Get past the headlines, understand the strategy, see what's really driving this tech giant right now.
Exactly. And for this, we're using Intel's official Q2 2025 earnings release, and we've layered in real-time market data too. We're using a structured five-part framework. It helps put the results into context, see how they stack up against what the market was expecting. It's more than just the numbers, it's the story.
Okay, then, let's unpack this. We'll go through it segment by segment, almost like getting an inside look at Intel's strategy session. Now for slide one, the at-a-glance scorecard. So, right off the bat, Intel's Q2 presents this really stark contrast. Revenue beat expectations, which sounds great.
Yeah, pretty significantly too.
But then the loss per share was much bigger than anticipated. It just screams internal strategic moves rather than just market conditions, doesn't it?
It absolutely does. Let's put some numbers on that. Revenue came in at $12.9 billion.
Okay.
And the consensus estimate was only $11.95 billion. So a clear beat on the top line.
Right. Strong sales.
But the non-GAAP EPS, that was a loss of 10 cents per share.
When the expectation was for a profit of 1 cent. Ouch.
Exactly. A miss. And that difference, that tension between good revenue and a bad bottom line, that's the core story this quarter. Interestingly, though, the market barely blinked. Stock was down, 0.17%. Very muted.
So investors basically saw this coming. They expected the hit from restructure.
It seems so. The narrative among analysts leading up to this was very much, it'll get worse before it gets better. They saw these results as a kind of necessary step.
And looking year over year, that profitability hit looks even more dramatic. Total revenue was basically flat, right? Up just 0.2%?
Yeah, $12.86 billion versus $12.83 billion last year. Almost identical.
But net income attributable to Intel, that just cratered, down over 81%. A loss of nearly $3 billion.
A huge drop, $2,918 million to be exact. And diluted EPS on a GAAP basis followed suit, down 76.3% to a loss of $2.67. It's a massive swing.
So what's fascinating, as you said, is this wasn't just bad luck or a market downturn.
Not at all. This was, well, deliberate. Management decided to rip the Band-Aid off, as the saying goes. The press release is very clear. $1.9 billion in restructuring charges, plus about another $1 billion in impairment and other one-time costs.
Okay, so nearly $3 billion in deliberate charges.
Right, and these directly hit the income statement. And crucially, remember that non-GAAP EPS miss, the $2.10 loss.
Yeah.
That was entirely because of these charges. The release specifically mentions a 20-cent negative impact just from impairments and one-time costs on that non-GAAP figure.
So without them, they actually would have beaten the estimate, like $0.10 profit instead of $0.11 estimate.
Precisely. Non-GAAP EPS would have been $0.10. So the takeaway is clear. The bad bottom line wasn't. Weak demand revenue proved that wasn't the case. It was a strategic choice, a costly forward-looking choice.
That GAAP versus non-GAAP difference is obviously critical here, but maybe quickly clarify basic versus diluted EPS, and why are they both $1.67?
Sure. Good question. Basic EPS is pretty simple.
Yeah.
Net income divided by the average outstanding shares. Straightforward.
Okay.
Diluted EPS is a bit more conservative. It adds in any potential shares that could be created, like from stock options or convertible debt. It gives you a, potentially lower EPS figure.
So why are they the same here?
Because Intel had a net loss.
Yeah.
If you add more potential shares when there's a loss, you actually make the loss per share smaller.
Which would be misleading.
Exactly. It's called anti-dilutive, and accounting rules don't allow it. So when a company reports a loss, basic and diluted EPS are usually identical, showing the full loss per share.
Moving to slide 2, the engine of profitability, deconstructing the restructuring impact. Okay, so keeping those huge charges in mind, let's look at slide 2. This really shows the scale of these write-offs and the Grand Canyon between GAAP and non-GAAP profits.
It really does. Look at the GAAP numbers first. Gross margin fell sharply, down to 27.5% from 35.4% last year.
Ooh.
And operating margin, it went deeper into the red, a loss of 24.7% compared to a 15.3% loss a year ago. On a GAAP basis, it looks like the business is, well, in serious trouble.
Almost free-falling based on those numbers alone. But as you mentioned, the non-GAAP figures paint a rather different picture.
They certainly do. Non-GAAP gross margin was 29.7%, still down, but better. And non-GAAP operating margin was negative 3.9%.
Okay, so still a loss, but much closer to breaking even than that near 25% GAAP loss.
Exactly. The GAAP operating loss was a massive $3.2 billion. The non-GAAP operating loss was $503 million.
And the difference is mostly that $1.9 billion restructuring charge.
Primarily, yes. That's the biggest chunk excluded from non-GAAP.
Yeah.
So if you're an investor trying to understand this,
Yeah.
the GAAP numbers show you the cost of this big turnaround effort, the pain they're taking.
Okay.
While the non-GAAP numbers give you maybe a clearer view of how the core business is performing right now before factoring in those big strategic cleanup costs.
And it's important to remember what these charges actually are. This isn't just numbers on a page. It's Intel admitting past mistakes, right? A strategic retreat.
Absolutely. It's a tangible admission of past inefficiencies. The release mentioned about $800 million in impairment charges for excess tools with no identified reuse.
Tools they bought but now don't need.
Right. And it also confirmed they're outright canceling those big factory projects planned for Germany and Poland.
Wow, those were multi-billion-dollar plans.
Exactly. It's a direct reversal. It signaled capital was misallocated before. The new team is taking its medicine now.
The CFO, David Zinsner, was quoted saying something about capital efficiency having a positive impact.
Yes. He said, the changes we are making to improve our capital efficiency are having a positive impact. They see this painful short-term action as crucial for better long-term returns. And just to quickly recap that GAAP versus non-GAAP thing for you listening, GAAP is the standard rulebook, very consistent. Non-GAAP is extra info, management's view, where they pull out things they see as one-offs, like these big charges.
Got it. Need to look at both. Now for slide 3, the engine room business segment performance. All right, understanding the big picture strategy and costs, let's dive into the engine room itself. Slide 3 looks at the different business segments. This is where you really see the tension in their strategy, I think.
You do. It breaks down nicely. First, you have their core product businesses, Client Computing Group, CCG Think PCs. Revenue was $7.9 billion, down slightly, about 3.3% year over year.
Okay.
But it generated solid operating income, over $2 billion, $2,053 million.
Healthy profit there. And the other core.
Data Center and AI, DCAI. Revenue there was $3.9 billion, actually up a bit, 3.5% year over year.
And profit.
$633 million in operating income. So you add those two together.
CCG and DCAI.
These core Intel products brought in about $2.7 billion in operating profit combined. Pretty solid.
Okay, $2.7 billion profit from the core businesses. But here's the kicker, right? That profit was just gone. Erased completely by the Intel Foundry segment.
Completely. The Foundry, which is Intel's big bet, their plan to make chips for other companies.
Yeah.
It reported revenue of $4.4 billion, up about 3.2% year over year. Sounds okay on the surface, but it had an operating loss of nearly $3.2 billion.
Wow. $3.2 billion loss from just that one segment.
Yes. That single segment loss was bigger than all the profit from CCG and DCI combined. It dragged the whole company deep into the red operationally. It just highlights the immense cost of building out this foundry business right now. Its success is absolutely critical, but today it's a huge cash drain.
Which leads to the really interesting question. You see that foundry revenue, $4.4 billion. Who are they selling to? Is this new external business?
That's the million-dollar question, or maybe the billion-dollar question here. And the segment data actually gives a pretty clear answer.
Okay.
The Foundry's main customer is still Intel.
Intel itself.
Yes. Look deeper in the report, you see that Foundry revenue of $4.41 billion. But right below it, there's a line called Intersegment Eliminations for $4.421 billion.
Intersegment eliminations. What does that mean?
It means they're subtracting out the revenue from sales between Intel's own divisions. So basically, almost all that $4.4 billion in foundry revenue came from selling wafers to Intel's client computing and data center groups.
So that 3.2% revenue growth isn't really new customers.
Not external ones, no. It's more about internal production flows and accounting. This is really important for you watching. It means the foundry becoming a viable external business is still very much a show-me story.
They need to prove they can win big outside clients.
Exactly. That's the real test. Its success hinges on that, not just supplying itself.
Moving to slide 4. Financial strength and shareholder rewards. Fortifying the fortress. Okay, let's shift gears a bit. Slide 4 talks about financial strength and shareholder rewards. Given the losses and the massive foundry investment, it feels like Intel has gone into, well, fortress mode.
Fortress mode's a good way to put it.
Hmm.
They're clearly prioritizing shoring up the balance sheet over sending cash back to shareholders right now.
Is the balance sheet strong enough for this? How leveraged are they?
Well, they definitely have debt, about $50.8 billion as of the end of the quarter, but they also have substantial equity, around $105.8 billion.
Okay.
So that gives you a debt-to-equity ratio of about 0.48.
Which is pretty conservative, right? Less than 1.0.
Generally, yes. It suggests the company is financed more by equity than debt. It gives them stability, gives them a runway to execute this turnaround, even though it's expensive.
And you see that fortress mode in their capital actions, or maybe the lack thereof.
Absolutely.
Yeah.
Look at the cash flow statement for the first half of 2025. 0 payments for dividends.
They cut the dividend earlier, right?
They did. And no mention of share repurchases either. They're holding on to cash.
And even raising cash. Selling assets.
Exactly. The report highlights they sold a big chunk of their Mobileye shares in July, after the quarter ended. About 57.5 million shares.
How much did that bring in?
Around $922 million. And they explicitly said it was to strengthen its balance sheet and monetize non-core assets.
So, putting this all together, suspending the dividend, no buybacks, selling off Mobileye shares, these aren't just random unconnected things.
Not at all. This is a pattern. It's absolutely a unified strategy.
Okay.
Every major financial lever they pulled this quarter, holding on to cash, raising cash, taking those big charges to reduce future costs, canceling future spending like those factories, it all points one way.
Towards funding the foundry pivot.
Exactly.
Sure.
Marshal all resources for the foundry transformation and reset the overall cost structure. That internal consistency, even though it involves painful steps now, shows management is very focused on a specific, albeit difficult, plan.
Finally, for slide 5, the road ahead management's outlook and key takeaways. All right, let's wrap this up with slide 5. Looking ahead, what's management saying? What does the guidance tell us about when things might start to improve?
Well, the CEO, Lipertan, was pretty direct about it. He acknowledged the work ahead. He said something like, our operating performance demonstrates the initial progress. It's going to take time, but we see clear opportunities to enhance our competitive position, improve our profitability, and create long-term shareholder value.
So basically, we're making progress, but be patient, framing the current pain as an investment.
Pretty much, it sets expectations.
And what about the actual forecast for Q3? Does that guidance signal relief is coming soon?
Not immediately, no. The guidance for Q3 2025 suggests the pressure continues. They're forecasting revenue between $12.6 billion and $13.6 billion, so potentially flat to slightly up sequentially.
Okay. And earnings?
Non-GAAP EPS is forecast at $0.
Break-even on non-GAAP.
Right. And the GAAP EPS forecast is still a loss at $2.24.
So the benefits from all that restructuring aren't hitting the bottom line yet.
Not in Q3, it seems. Profitability stays under pressure. It signals the recovery is going to be a grind through the rest of the year at least.
Okay, so let's pull it all together then. If you had to summarize the key takeaways from this whole deep dive into Intel's Q2, what would they be?
I think there are 4 main points that really stand out. First, revenue beat masks on the new. Deep restructuring pain. Good underlying demand, yes, but totally overshadowed by that massive, deliberate $1.9 billion charge and other write-offs. Shows they're prioritizing the long-term cost reset.
Right, the pain was intentional.
Second, foundry strategy is a cash-burning show-me story. That huge $3.2 billion loss, the fact its revenue is still mostly internal. It's the biggest challenge, the biggest risk, and where they absolutely have to prove themselves to external customers.
The whole strategy hinges on it.
Third, fortress balance sheet is the priority. Suspending dividends, selling Mobileye shares, it's all about hoarding cash to fund this multi-year transformation. Shareholder returns are on the back burner.
Makes sense, given the costs involved.
And finally, guidance signals continued struggles. That Q3 forecast, break-even non-GAAP and a GAAP loss, tells us the financial pain isn't over. The road back to solid profitability looks challenging through the second half.
That sums it up really well. It's like the final narrative is the price of a pivot. This wasn't a simple beat or miss. It was a messy, calculated, pretty painful chapter in a massive company trying to reinvent itself. You've got resilient demand on one side.
Which is good, provides a foundation.
But on the other, this huge self-inflicted cost to unwind the past and bet big on the foundry future. Management is basically telling investors, this will be long, it will be expensive, but we think it's worth it for the long haul. Patience is definitely required. So, thinking about this, what does it all mean for you listening? How does understanding these strategic choices, even the painful ones, help you make sense of future headlines about Intel or any company really? Can using a framework like this, breaking things down, change how you approach complex information you encounter? Something to think about. Now, just the usual quick reminders. This report is purely for informational purposes. It isn't financial, investment, legal, or tax advice. Any investment decisions you make should always be based on your own thorough research and talking with a qualified financial professional.
And one more thing. This analysis was generated with the help of an artificial intelligence model. It uses data directly from Intel's official press release and public market data. We strive for accuracy, but errors or omissions are possible, so please always double-check and verify any information independently.
Like and subscribe to stockanalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.